Good afternoon, and thank you for joining us for today's webinar, Unmasking GASB 96, Conquering the Fear. I'm Becky Wyan, and will be moderating today's presentation. Before we get started, there are a few housekeeping items to cover. If you have any questions during today's presentation, you may enter them into the chat box on your screen. We will try to answer as many questions as we can at the conclusion of today's presentation. However, to be respectful of your time, if we don't get to all the questions, we will follow up afterwards with answers to all those questions. And we will also be sending out slides, today's slides. Today's webinar will be given by Jared, our principal on our Rea government team, and he will be navigating us through the world of GASB 96. Welcome, Jared.
Okay, thank you, Becky. Yeah, and thank all of you for showing up today. We really appreciate you giving us some of your time. I know it's on a lunch hour, but hopefully you're able to multitask here and maybe have lunch at the same time while you're learning a little bit more about GASB 96. Well, I think this is going to be a huge benefit for all of us. There certainly is a huge benefit to Rea Associates, and that we have found that this standard has been a challenge, to say the least. And so getting us all on the same page early in the process like this and getting the ball moving early, and we'll talk about timelines a little bit later about kind of what our goals are, but getting the ball moving now is going to benefit us all, so we're not scrambling come March, April, May, or whenever it is that you're going to be filing your financial statements. So really appreciate you being here. GASB 96, subscription-based information technology arrangements. I know that's a mouthful. We refer to it as SBITA. So that'll be a term that you're probably all going to become very familiar with here over the next 2-3 months. And it's been a real challenge for us, because while we've always prided ourselves on being your accounting experts, this is something that there's a certain piece to it that is kind of outside of our comfort zone, and that's just some of the terminology that we're coming across in these agreements that we're now having to read and decipher. What is this agreement? Part of the invitation for today was that not only the treasurers and finance officers and finance directors are participating in this, but that you also invited your technology folks, whoever that may be. Hopefully some of you did that, and if not, that's okay. We're happy to have these meetings again with you and your technology folks later in the cycle, or maybe you feel comfortable having this conversation with your technology folks. But moving on, so why do we have GASB 96? And again, if there are IT folks on the phone, I don't want to bore you with a lot of the details of what we've already been through with GASB 87, but the GASB came out with GASB 87 and we implemented that last year, and it had to do with tangible capital assets, things with a physical substance. So we're talking about leasing buildings and copiers and land and cell towers and things like that. And I think when they were going through GASB 87, they kept coming up with this issue. Well, what do we do about software agreements and things like that? And then let's just put that off for now, and we'll address it in another standard. And so they kind of staggered these. We had 87 last year, and now we have 96. So there you have it. By definition, you're entering into these agreements. They're becoming more and more common for you to enter into these software subscription type agreements, and just the volume of them are coming through. And we haven't had anything addressed besides tangible capital assets, and now 96 is going to address the software side of things. Prior to the issuance of GASB 96, there was very little guidance in the standards regarding information technology software type arrangements. We did have GASB 51. GASB 51 was issued obviously quite a few years ago. We're on 96 now, but it really focused on governments in their purchasing of software. And so just to point out that GASB 96 does not just completely do away with 51. 51 is still a standalone GASB that we follow for when your entity is purchasing a software package. 96 is really focused on you entering into agreements for the right to use for a period of time another party's software. So kind of jumped the gun a little bit there. Moving on to the next slide with, what are we not talking about here? So again, I just started with, we already have GASB 87 that deals with like technology hardware type things would be included under 87. Now, I do want to caution you that we are finding that when we're asking our clients for information on their software arrangements, we're starting to get a bunch of arrangements that are predominantly hardware related. Technically, those agreements should have been captured as part of 87, and it's not a huge concern, but there is a chance that we've missed something with 87, and that we will now pick those items up in accordance with 96. Which in a lot of cases, these agreements, they're not just software or hardware. Usually there's some combination of hardware and software. So I think we're okay just capturing all of those items in accordance with 96. We are also not talking about, I've got a few more things here, Becky, but we are not, whereas GASB 87 had two components to it. It had guidance for when your entity was using another party's asset, and there was also guidance when you were letting a third party use one of your capital assets. So there was the lessee-lessor arrangement in 87. That does not exist in 96. Again, probably just because it's going to be so uncommon, but if you were to have, for some reason, written your own software for something, and you were turning around and letting somebody else, entering into an agreement with a third party to use that asset that you created, and you had an agreement with them, it wouldn't be something that we would apply 96 to. We would probably go back to 87 for guidance on that and follow their lessor guidance, but 96 wouldn't cover that. We're also not going to cover, there is another standard, 96 and 94 are the two big standards that we're going to be implementing for this calendar year. 94 relates to, we call them PPPs. It's either a private-private partnership, or I'm sorry, a public-private partnership or a public-public partnership. This is where your entity has entered into an agreement with either another government or a for-profit or a not-for-profit entity to either you use one of their assets for a period of time, or they use one of your assets for a period of time. Again, we don't think this is going to, so an example of that would be, and it's been a while, but Ohio State University years ago entered into an agreement with an external third party to operate all of their parking garages on campus. And that third party paid Ohio State billions of dollars up front for this right to use those parking garages for a period of whatever it was, 50 years. That hopefully gives you some color to what we're talking about with what is a public-private or a public-public partnership. That would fall under GASB 94. So I just wanted to mention that because it's not the purpose of today's call. But if that, talking about that there triggers something where you're thinking maybe you have a relationship that would fall under GASB 94, please let us know that right away. We'll dive into the trees on it and see if it's something that is going to require different accounting treatment than what we've done in the past. And then again, I've already mentioned the last bullet there, GASB 51 is where we're talking about perpetual licenses or the permanent use or the acquisition of software from a vendor. So we're not talking about that here. Obviously, if you've done that, we need to make sure we've got it accounted for properly in accordance with 51, but it's not a new issue that we're going to address with GASB 96. So what is a SBITA? This is the definition right out of the standard. It's a contract that conveys control. That is going to be something that we focus on here over the next couple of slides. There are a number of things to discuss there. What do they mean by conveys control of the right to use another party, a SBITA vendor, another party's IT software? And again, like I mentioned, it could either be alone, the software itself, or in combination with tangible capital assets, a combination of software and hardware, as specified in the contract for a period of time. We refer to that period of time as the term of the agreement. And that's another topic that we're going to spend some time with in an exchange or an exchange-like transaction. So that last piece there, and if any of you have the definition of a lease that was provided to us in GASB 87, if any of you have that committed to memory, you'll see that the definition of a SBITA is almost identical. It's just replacing tangible capital assets with IT software. Now, the exchange or exchange-like transaction means you can't enter into an agreement to use somebody else's software and agree to pay them $1 a year. That's a non-exchange transaction. So that would be something that we would be accounting for under a different standard altogether. There has to be either equal value or at least some value exchanged in this transaction in order for it to be eligible. Okay, conveys control. Again, by definition, what are we talking about when we say control? Two things. One, you have the right to obtain the present service capacity from using that IT asset. And number two there is the right to determine the manner and use of the IT asset. And this is something when we first, at least when I took my first read on GASB 96, this didn't really seem like something that was going to be as big as it is, I guess. But this control component is something that we're having a lot of discussions with our clients about. Like, are you really controlling the use of that IT asset, that software that you have an agreement for? Or are you simply acquiring the use of the outputs of that software package? One of the, which I think, again, just to demonstrate that point, one of the examples we gave to our school districts, that, again, lucky for you, we've already been through a round of this with our schools. They had to implement all of our June 30 clients. We've been working over the past 4 or 5 months getting them implemented. So we already kind of have learned some lessons along the way. And control is one of them. But the example we gave them was, okay, if a teacher goes out and says they want to enter into an agreement with a vendor that allows them to go out to that vendor's website and download tools, worksheets, study guides, whatever it may be, to download those resources and to use them in the classroom. And it was simply just downloading things from the website and turning around and using them in their classroom, as opposed to an agreement with a vendor where the teacher can go out to that website, use the tools on the website to create, use the software to create worksheets and tailor them for that specific teacher's needs to be used in the classroom. One of those, the first situation where you're just simply downloading resources, is simply controlling the output and would not be something that we would consider applicable to GASB 96, whereas the latter, where the teacher is actually using the software provided by that vendor to meet their needs, and that is something, that's what we're looking for things that apply to GASB 96, control and use of that software package as opposed to just simply using outputs. The next slide that I have here goes a little bit further to demonstrate that. And again, this school cycle was a big learning curve for us with using this term of supply contracts. And this is one, particularly if you have your IT folks in the room, this is something that we're going to be picking your brains on this to see whether or not this applies or doesn't apply. But this was a concept that was introduced by GASB 87. So 96 really doesn't mention it, but we're falling back on the guidance in 87 and then turning around applying it to 96. And what 87 says is that supply contracts, such as power purchase agreements, are simply acquiring those outputs of the asset. Sure, there's hardware and there's software being used to as part of that agreement, but the governmental entity is only benefiting from the outputs rather than controlling the right to use the asset. So we're using this supply contract definition provided to us in '87. And the way we view it, if you look at the second bullet there, we consider things like utility bills or power purchase agreements, phone service contracts, internet service contracts. They all they're all, particularly phone service contracts and internet service contracts, the agreements are going to just spell out all the hardware and software that's going to be used to provide that service. But where we've landed on this is that the vast majority of those types of things are going to fall under this supply contract, and that you are acquiring the output. And it's important because some of these agreements are 3, 4, 5 years long, and the payments can get pretty substantial. And so that's one. I just want to caution you now that if you have these types of arrangements, and if they're long-term, we'll explain a little bit later why long-term matters, meaning more than a year. We're going to have some sit downs with this, and we're really going to be relying on, it's going to be a collaborative effort, but we're going to be relying on the folks most in the know on what's really taking place there, and that's your particular entity's IT professionals. With our accounting knowledge, with the IT professionals' knowledge on staff with the governmental entity, we're going to together make a decision on, do we think this meets the definition of 96 or not? And I say we, maybe you guys will feel comfortable doing this on your own, and we'll talk about that a little bit more later towards the end of the webinar here today, about whose role is it to do what. So control, you're fine. We're going to move on to subscription term, but just in summary, we want to make sure that you're actually controlling the use of a software package and just not controlling its outputs. So that's a critical term. Segue into subscription term. This is where the definition spells out for us that it has to be for a period of time. Well, how do we define what that period of time is? And it's not as easy as you'd think. Right there in bold print, one of the biggest ways we get out of reporting some of these agreements is they have to be non-cancelable agreements. So I'll just say right out of the gates here, if you've got an agreement and it says that either party can cancel this agreement within 30 days notice or 60 days notice or 90 days notice, that is a cancelable agreement and would not apply to GASB 96. We really want to focus on non-cancelable agreements that extend beyond one reporting period or extend beyond 12 months. The agreement, and so we're getting ready to, these next 4 steps here are, does the agreement have options in it? Is it a 1-year agreement with an option to extend for two more 1-year periods? Is it a 5-year agreement that has options to extend for 2 more 5-year periods? We've seen just about everything you can imagine here in these agreements. So we would include, if the government has an option to extend, and if it's reasonably certain that it will exercise that option, that's where you guys will be making that call. We would want to include that option to extend as part of our term. If you have an option to terminate the agreements, and it's reasonably certain that you will not terminate, then we would include that term as well. And then the same on the vendor. If the vendor can extend and it's reasonably certain that they will, if the vendor can terminate and it's reasonably certain that they will not, then we would include basically all of the, how long do we think this contract's going to go? Another thing to point out there is any period where both the government and the vendor have an option to terminate without permission of the other party would be considered a cancelable portion and would be excluded from the term, because we see that quite a bit. We see a lot of 12-month contracts that either party can get out of it at the end of that 12-month period. So those would, anything beyond that 12 months would be cancelable. So that would be something that would be considered a short-term contract. Let me jump to, okay. So yeah, moving on to this term of short-term subitas. So I think we've already talked about control. Control is one of the key features in our determination of does this apply or doesn't it. And even a bigger criteria is this term of short-term subitas. So by definition, a short-term subita has a subscription term that has a maximum possible term of 12 months or less, including any options to extend. What we're finding with these agreements, as far as, and even all of the renewal and termination options, and I'm sure you will agree with this too, a lot of them are, we're not actually able to track down a formal agreement like we were when we implemented GASB 87. With copiers, we were always able to nail down a 2 or 3 page agreement with the vendor that kind of spelled some of these things out. It's been quite the challenge to get that same level of detail for these subitas. And oftentimes it's our clients are providing us with a purchase requisition, or some cases a purchase order, or maybe it's a quote from the vendor. And really it just leaves a bunch up for question as far as, well, what's really going on here? Some of the information we're getting they have links in the PDF document that takes you out to the vendor's website where we can find terms and conditions. So a little more work on our end to get to what are the actual terms and conditions of this agreement. What we found is we've been relying on the IT folks. We've been relying on the people internally to say, okay, what's your understanding of this? You know, in the absence of agreement, can you, at the end of this period, can you just tell them you don't want to do it anymore? Or are they committed to providing this to you for a longer period of time? And so we're having a lot of those types of conversations and nailing down what is the term of this agreement. But we're finding a lot of these software type agreements are 12 months or less, which pulls them out of the GASB 96 bucket. And we would just like you always have when you make those subscription payments for those types of services, we would record them as expenses in the year that you make those payments. Now, yeah, we're going to talk a little bit more about when we get to the last slide, we're going to talk about implementation steps. We want to evaluate all of these agreements, particularly in year one. We want to make sure that even if you're going through a bunch of stuff and you're determining that no 12 months or less, no 12 months or less, or no, we don't have control, we still want to just put together a very good audit case so that we don't run into any trouble. We want to show your auditor that we implemented 96 by analyzing every possible agreement that we could for applicability. And then the ones that we decide aren't, we'll just spell out on there that why we feel it's not applicable. And again, I think our auditors will appreciate that. Okay, so moving on to recognition and measurement at commencement. So the whole theory here, just to kind of get a little nerdy accounting on you here, but what the GASB is telling us is, if you enter into a long-term, more than 12 months agreement that's non-cancelable with a vendor for a software asset, you've basically financed the purchase or the right to use, I'm sorry, not purchase, you financed the right to use that asset for that period of time. And they want us to book it in your financial statements like you've acquired this intangible right to use this asset, and you have a liability on your books. You have a subscription asset and you have a subscription liability. And it basically wants us to treat it just like we did 87, as though it's a financing, and they want us to present value all of those future payments to get it back to an amount, and then basically show principal and interest payments throughout the life of the agreement. So I know it just sounds kind of strange to go through that, but they are just trying to be consistent with how we're treating other types of assets and liabilities. That second bullet there, I don't think it's going to apply, and we've got a slide on it. I'll walk 2 slides on the stages of implementation. Some of you may have commenced like a big software acquisition project or replaced your GL package or something, and it's something that maybe happened over more than a 12-month period. Maybe it happened over a 2 or 3 year period, as far as working with that vendor and getting that new software package up and running. I think that's going to be the exception more than the norm. But if we have these long-term type agreements where you're putting a lot of effort into it, there's certain criteria on how much of those costs are we going to capitalize as part of that subscription, and how much are we going to expense. So if you, the vast majority of what we're dealing with 96 are little 1, 2, 3, 4, or 5 year agreements for subscription-based software, and they're really, those stages of implementation aren't going to apply, but there are going to be some situations where they do. So if you have any long-term projects like that, bring those to our attention right away too, because those will require a little more analysis on our end. So that's the the gist of what the GASB is trying to accomplish. So now I've got a couple slides here just so you can see how are we, in the end, how are we going to come up with what is the liability amount is where we're going to start, and then how are we going to calculate that subscription asset amount that we're going to put on your financial statements. And again, we're going to do all of this for you, but I think it's just good to see behind the scenes what's happening. So the initial liability itself is going to be, you can see there, we've got a list of things, all fixed payments, all variable payments that are based on an index or a rate. So if there's a variable payment that says that it's going to increase 3% every year, or whatever the case may be, that we would want to include those as well. Any other variable payments that are fixed in substance. If you have any variable payments that are dependent on the use of that asset, or in the case of our schools, maybe it's based on an enrollment figure that's going to fluctuate every year that isn't fixed in substance or isn't based on an index, we would exclude those types of payments. So basically, if we don't have a good handle on what that payment's going to be, we would exclude it from one of our payments that we're going to include in the subscription liability. So we would add all of these up over the full term of the agreement. So 1 year, 2 year, 5 year, 10 year, we would look at all of those payments being made into the future, and they would all become, and we would do a present value calculation that would get them back into what are all of those payments, what's the value of those payments today, and that's what we would book as your liability. We're gonna, again, most of you are gonna be familiar with this, but we need to come up with a discount rate. That discount rate is how we're going to calculate the present value. So the discount rate is basically what rate would you be able to get if you wanted to go out and finance all of those payments that you were making to those vendors. We've already got a pretty good process in place because we had to do this with GASB 87 as well. We'll either look at a recent bond issuance that you've had, or any sort of financing, formal financing that you've had, see what that rate is, and then apply that rate to these SBITA agreements. It's also referred to as your incremental borrowing rate. So you might be familiar with that term as well. And again, for a lot of you, we've already probably used the same rate that we were using for GASB 87, unless there's a good reason for us to increase it or decrease it based on your current condition compared to what it was a year or two ago. And then, so what we're going to do is we're going to present value those payments, and then we're going to amortize them as you make a payment. You know, a portion of it's going to be applied to principal, that liability amount, and a portion is going to be applied to interest based on this discount rate that we used. So again, kind of a new concept there. Another thing there, and we only see this when we have very large agreements, but if you have agreements, subscription liabilities that are 10, 12, 15 years out, there's a good chance your interest number is going to be a pretty large number. So that last bullet there says that every payment that you make out gets applied to interest first, and then it'll turn around and be applied to the liability. We have some long-term agreements that we've had through 87 that they were 50 to 100 years each, and every payment out the door all got applied as an interest payment for the first 10 to 15 years of the agreement, and then you start chipping away at the principal after that. So it's rare, but it does happen. Now the asset is it's going to feed from that liability number that we calculated. So total payment stream, present value it, there's your liability, and that's your starting point for the asset. So if my liability is 100,000, I'm going to start there, but then I'm also going to take into consideration if I've made any payments up front. And this is a pretty common thing too. Maybe the agreement calls for an upfront payment of $50,000 and then 36 months of payments, $3,000 a month, and that's the agreement. So your $50,000, since it's paid up front, it won't be part of that future payment stream that we're going to use to calculate the liability. So you've already paid it; it won't be part of your liability. But we got to remember to go and add that to the asset amount. That $50,000 that you paid up front is going to be part of the asset, in addition to the 36 payments of $3,000. And then again, capitalizable implementation costs, initial implementation costs. This is something that's going to be very rare. We'll take it case by case, and I'm sure we'll ask about it again from you, but it's probably not going to apply. But if you have an initial implementation cost, well, we'll go ahead and talk about that. I think it's either on the next slide or the next two coming up. We'll talk about these stages of implementation and better define what is an initial implementation cost. So now that asset, okay, so it's going to have to be amortized. For those of you that aren't familiar with that term, basically it's depreciation. Because again, we're talking about an asset here. Our tangible capital assets are being depreciated over their life, and that's determined by you. These subscription assets are going to be amortized over the life of the agreement, or the life of the asset, whichever is shorter, or whichever is longer, sorry. So that's something that in most cases we're going to be able to calculate for you, and that probably won't come up in any of our conversations. It's probably just going to be the actual subscription term. And so in essence, we'll be wiping that asset down to zero at the same pace that the liability is going to be wiped down to zero. Okay, stages of implementation. Again, I don't want to spend too much time on this. I just want to introduce the concept. If this triggers, anything with any of you, probably let us know about this right away, because this is something we haven't seen a bunch of. So it might take us a little bit longer on our end to get our hands around it and make sure that it's accounted for properly. I already kind of introduced the concept of these long-term projects, IT software related projects that you would enter into. So the GASB gave guidance and split it up into 3 different stages. There's the preliminary project stage, which is kind of the conceptual formulation and evaluation of alternatives. So this is putting out an RFP maybe, and evaluating the vendors that responded to that RFP, kind of identifying the nuts and bolts or the scope of the engagement. All of that work going into that would be considered the preliminary project stage. Then you would have the initial implementation stage. So you've got your vendor in place, and now you're going to go through and work with that vendor and start designing the product and kind of to your specification, configuration, coding, testing, installing. So that's everything that happens between you deciding what exactly do you want to do. Once you've made that decision, we've decided what we want to do, and getting it completed, that's all the initial implementation stage. And that could be, it could be a month, or it could be 6 months, 12 months, 2 years. It could be a long period of time. And then you have your operational and additional implementation stage. That's where at least one, maybe there's multiple phases, at least a portion of the asset has been placed into service. Maybe you've got your GL package or your accounts payable module up and running, and now you're going to wait, and maybe next year you're going to do payroll, and the year after that you're going to go and put a capital asset module on top of that. So once the initial product has been placed into service, everything after that's going to fall into this bucket of maintenance, troubleshooting, training and education, and adding additional modules. So those are kind of the 3 stages. The next slide that I have here talks about, well, how are we going to treat those 3 stages from an accounting standpoint? Everything that happens in that preliminary project state, where you really don't even know, and you technically could pull the plug on the project, what exactly is going on, you're going to expense all of those costs. And maybe you have a consultant come in and help you figure out, what you want to do there. Those are all going to be items that are expensed. The initial the initial implementation stage where you actually have a vision now, you have a scope, and you're starting to execute. You may not have a subscription yet because the asset hasn't been placed into service, but you're starting to incur some cost associated with this asset. We want to start capitalizing those costs. So we don't want to expense them. And if we overlap a year, we're going to want to know, well, what were the total costs that you put into your new software design project that you guys are working on? And we're going to want to capitalize those costs and put them in something similar to like almost like a construction in progress account is kind of what they would go into. It would be, we hit the balance sheet with it, but we're not going to start amortizing it yet because that asset hasn't been placed into service yet. And then again, once that third part there, operation and additional implementation stage, once we place at least one module into service, we're going to start amortizing that asset, and it's going to be placed into service, and we hit the go button. During that phase, the operation and additional implementation phase, most of it, all of your maintenance and training and education and things like that, they're all going to be expensed. They're not going to be part of that asset anymore. The only thing that you would want to pick up after the initial implementation of that first module would be anything that's going to increase the functionality or the efficiency of the asset that you just created. Again, the most common example is you add another module, or maybe you do something that improves, again, the functionality or efficiency of that first module that you put into service. We'll be looking to you for help, if applicable. We'll be looking to you to help us identify those types of things. It's just not our area of expertise. But those will be capitalized as well. Training costs are going to happen throughout all three phases. And the GASB is very specific that all training costs are going to be expensed throughout the life of that software project. And again, I don't want to confuse anybody here. This is just for projects that the ending result is a subscription to use. You never acquire the software, and you don't acquire a perpetual license to use it. The end result is you're designing it, what you want from that vendor. They're going to help you put it into place, and then they're going to charge you a subscription fee to use that software for 2 years, 5 years, 10 years, 20 years. But you're never the owner of that product. If you entered into a project like this and you became the owner of the software or acquired a perpetual license, that would put us into GASB 51, like I talked about earlier. And we have seen that. It's just, it's not all that common, but that's just a differentiation there. Is it a 51 issue or is it a 96 issue? Okay. So now, again, just kind of recapping, we basically have to pick up long-term software agreements in your financial statements. There may have been some hardware-related items that we missed with GASB 87, with some tangible capital assets. There's a good chance those agreements will have a software component to them as well, so we're going to pick those up while we implement GASB 96. So please, when we go through this process that I'm about to walk through, we want to capture everything, whether it's software or hardware, because we'll know whether or not we've picked it up already with 87, and if not, we'll make sure we incorporate it with 96. Two key features that we're going to focus on is control. Are we acquiring the right to control an asset, or are we acquiring the right to control the outputs of the asset? That's a distinction that we have to make. If we're just acquiring the right to use the outputs of a software package, it is not applicable for GASB 96. And term is going to take some time. It's going to take some digging. It may even require some calls to vendors to help us define what are the terms of the agreement. What are the renewal options? What are the termination options? Is it cancelable? Is it not cancelable? So just going through this implementation guide. So the first thing to point out there is, we're implementing GASB 96 for fiscal year 23. And you need to base all of your initial implementation decisions off of the facts and circumstances that existed at the beginning of the fiscal year. So you're going to want to focus on any agreements that were in place as of January 1st, 2023. In addition to that, any agreement that was in effect on that date and any new agreements entered into during fiscal year 23. And I just want to give you an example on that to demonstrate. If you were to have, maybe you have a 5-year agreement to use Microsoft Office, and we've made the determination that it's a non-cancelable agreement. And that agreement ran from 2000 and, it expired in 23. So it started in March of 2018, and it expired in March of 2023. When you go to look at that agreement on January 1st, 2023, that's a 3-year agreement that would be excluded from this. You wouldn't look at that as being a 5-year agreement. It's what are the facts and circumstances as of January 1st, 2023. Now, granted, you may have another Microsoft Office agreement that comes into play in fiscal year 23 that we'll have to capture. It might be another 5-year agreement for that same service that does meet the definition, but we wouldn't need to necessarily pick up the old one if it didn't have a life greater than 12 months. So the big first step is to identify all potential contracts. And again, I can't emphasize this enough. We want to be as thorough as possible so that we can show the auditor that we gave this some effort. Because in a perfect world, they just take what we give them, the spreadsheet with a listing of all of the agreements that we analyzed, and they do some quick double checks and maybe search for some things that aren't on that list and just be real simple with it and move on, as opposed to us giving them a list of the 3 agreements that we feel are applicable, and now they're worried about going through and looking at the other 25 agreements and making their own determination whether or not they should have been on that list or not. We're going to do all the work for them. We're going to identify all potential contracts. This is where, to me, there's two key components to this. The first is, and the most important, is getting that chief information technology, whatever that chief IT person is on your staff, to say, hey, I need help. This isn't something that I can just pull out of the finance office. Engage them, have meetings with them, work together with them to identify this list. But another big step that I have found helpful is just simply going through the check register for the year and looking for maybe you have a coding structure, an object code, or maybe there's an IT department and you have a departmental code that you can use to identify out of your accounting software these recurring payments that look like they might be for software, technology, hardware, software. So between those two things, we should do a good job of trying to get our handle around every possible agreement that we would want to evaluate. And then once we get this list, then the time-consuming part comes in. We actually have to do the research. We have to read these agreements. We have to extract that data. What is the payment stream? What is the term of the agreement? Are there renewal options? Are there termination options? We need to extract all of that information and get it into. We're using Excel basically, and we would be happy to share with you just some boilerplate Excel documents that we've been using that we used for our schools this year, that really kind of in columnar fashion picks up all the information that we need. And actually, I encourage that. I assume as part of our process to reaching out to you to start the 2023 prep, part of it will be giving you a copy of that. Use it if you want or come up with your own. But we need to get it all down into something that can be manipulated if we need to. Maintain documentation to support contracts that are deemed non-applicable. So again, my vision of this is we've decided that 25 agreements needed to be evaluated. And maybe we only determined that 5 of them were applicable, but we have a spreadsheet. We hand a spreadsheet to the auditor that lists all 25 agreements, and it has a section for applicable that has the 5 in it, and it has a section for not applicable that has the other 20, with a description of why is this not applicable. No control, supply contract, short term, less than 12 months, And so that's the type of documentation that our auditors are going to be looking for. In the unlikely circumstance that you do have a long-term software subscription project that you've worked on or that you're getting ready to work on, we would also want to identify these capitalizable implementation costs. You know, what are the vendors, what's the amount, and it's going to be kind of thrown into a construction in progress type account until we place that asset into service. So so a lot of our contracts, so there's a lot of work that needs to be done here. And our involvement in that, you guys are going to drive the ship on what our involvement is to helping you get where we need to be with this. Understanding that there's going to be a certain IT component to this that we're going to need your help identifying what does this mean in this agreement. Is this software? Is this hardware? Can you help me kind of decipher what this is saying? Because again, we don't really speak the language. But you can determine, in a lot of our contracts, the way they're written, because we knew these standards were coming down and that they were going to be very difficult with 87 and now with 96, is, hey, you know, you're getting a fixed fee from us to prepare your financial statements, but there's a clause in there that says we're going to have to implement this new standard, and the cost associated with that is unknown at this time. It's a variable cost that will either, you know, depending on how long it takes us. And you can understand that. I mean, you could do all of this yourself and hand us a finished product and say, Jared, here are our subitas. We've done the analysis. We feel comfortable with the terminology in 96. Just book these 5 and we're good to go. Or you could say, I don't want anything to do with this. We're hoping that's not the case, but you could just say, I don't want anything to do with this. I'll send you all 35 agreements that we think might be applicable. We want you to go and read through all of those agreements and make those determinations. And we'll have a couple meetings along the way because I know you're going to need my help and that kind of thing. So it could take us 5 hours to do this for your financial statement prep, or it could take us 50 hours to do this for your financial statement prep. We all need to be on the same page moving into it about what each of our roles is going to be in this. How involved do you want Rea Associates to be in this process? And again, we've seen both sides of the spectrum. So don't feel bad if it's one way or the other. It's just we need to communicate up front who's going to do what. And also have a conversation about cost, just so we're on the same page with that. I'm getting close to kind of wrapping up here before we open up the questions, but there's one other concept that I want to introduce to the group, and that is materiality. I'm gonna throw a number out here. I don't know, maybe have 100 school district preps that we did this past year. And for probably 90% of them, GASB 96 was not material to their financial statements. Some of our clients were very adamant that they didn't care about materiality. If it's applicable, I want you to book it. And that's fine, as long as we're all on the same page with that cost component. We've all sat down and talked about how long that's going to take and what that cost is. And we're happy to do whatever. We're open to booking or not, but that is a conversation we'll want to have with you, just so you know up front. That shell document that I mentioned that we're going to share with you, once we get all of those applicable agreements down, we're going to calculate what that total amount is, and we're going to run some analytics off of last year's financial statements for you that says, hey, your subitas in total are, you know, 0.7% of assets or whatever percent of liabilities. We'll make that decision together. And in a lot of cases, we even reached out to auditors during school season to say, hey, my client's debating whether or not they want to book their subitas. Like, what's the audit impact of them booking them or not booking them? Is it going to be something that is going to be in the management letter? Is it something that you're going to put on are you going to put it on your summary of identified misstatements? Or, you know, all auditors are different. Whether you have the auditor of state or another IPA firm, they're all going to have a different spin on this. So that's something that we're going to want to have conversations about too. And again, we're happy to do whatever you prefer. So a lot of work. We're here to help. And so I'm glad we're getting an early jump on this. I talked about timeline. Like, in a perfect world for us, we're not even having GASB 96 conversations in March, April, May. Like perfect world, maybe by the end of January. Maybe that's aggressive, but by the end of January, we've at least identified this population of contracts that need to be evaluated, and maybe we're done with it by then. But let's just not let this be something that trickles on in towards deadline time, because that's when then we have to start talking about extension requests and that kind of stuff, and we don't care to do that if we don't have to. So let's get an early jump on it, and please reach out to us. We could be happy to meet with you even sooner than the end of the fiscal year or into January to talk about this in more detail. So I guess with that, Becky, I don't know if we had any questions come in on the.
We did not have any questions just yet. We'll give it, you guys, if you have anything, go ahead and put it in on that questions tab and we'll answer them. If not, Jared's email's on there, or you can contact your Rea advisor. We're all available here to help you with this along the way. So nope, no questions yet. So we can go ahead and wrap it up. If you have any closing remarks, Jared.
Yeah, you know, my closing remarks, in addition to what I just said, would be if you didn't have your technology expert with you today, please try to do that before the end of the year. At least reach out to them. If you want some information from us, we've got some boilerplate emails that we've put together for our school district clients that kind of in email fashion spells out a lot of the hot points of GASB 96. We can get that over to you. You can get that forwarded on to them. We want to engage them as quickly as possible to at least give them a heads up this is coming, and maybe even schedule a meeting with them to talk about it. Again, we're happy to participate in those meetings as well.
All right, perfect. Thank you, everyone. And then as a reminder, we will be sending a copy of the slides as long as the recording of the presentation to you. It'll probably be either later today or early tomorrow morning. And I hope you guys have a great rest of the week. Thanks for joining us today. And thank you, Jared, for providing everyone with this great information.
Thank you.
Take care.